Hello, Chad the Mortgage Man here. Today we are going to talk about the labor market, mortgage rates, how they're intertwined, and the future for mortgage rates. So today the QCEW came out, the quarterly census for employment and wages. That report covers March 2024 to March 2025 employment data for basically 95% of the workforce. Today, it showed that we lost 911,000 jobs versus what we thought we had. So we didn't really lose the jobs, but based on the increase in jobs that was projected over the past year, this report says, hey, wait a minute, no, we lost jobs. It was kind of a big backwards step. So bottom line is, Jerome Powell has said we're in strong shape in terms of the labor market. And then recently when the BLS, Bureau of Labor and Statistics report came out, he said, well, maybe we're not, maybe it's softening. And then today, when the QCEW report comes out, he's definitely going to say, and the Federal Reserve is going to say, well, it's softening based on that data. So the Fed meets later this month. They're probably most likely going to cut interest rates by 0.25%. Doesn't mean mortgage rates will drop by 0.25%. That's a whole other story. But it puts pressure on rates to stay the same or maybe go down a little bit. So there's also a political slant to this where President Trump fired the head of the BLS, I believe it was around 3 weeks ago. He's always been saying the numbers under Biden, March 2024 to March 2025 is basically under Biden, have been inflated. So he's going to come out and say, look, we were right. But now on the flip side of that, a lot of people are saying, well, when the new reports come out as time goes on over the next 3 to 6 months, because of the trade wars, because of the tariffs, that we're not going to be in any better of a position because companies aren't likely to hire more people because of the uncertainty of what's going on. So there's a lot of pros, cons, drama, political drama. But the bottom line is when there's drama and uncertainty, and when inflation statistically seems to be getting under control, when you have a president who wants lower interest rates, and yes, that will help Americans lower car loan rates, they could refinance, lower mortgage rates, home equity loan rates. It can greatly help Americans, but it can also help the federal government as they borrow money or refinance their debt. So the question is, yes, we all want lower interest rates, but it's like a sugar high. If a kid gets sugar, they're going to have a lot of energy. That could be a good thing if they're going to go do activities, but then they're going to have a crash later. So the job of the Federal Reserve is to kind of balance that out. We don't want to get too high. We don't want to get too low. We don't want high inflation, but we don't want low inflation. So the bottom line is, I think based on the data that we have, that mortgage rates are likely to stabilize, stay the same. If right now they're 6.25, 6.3% for a conventional, 5.9% for FHA, I think the conventional rate will probably fluctuate between 6.1, which is lower than they are now, maybe 6.4, 6.5 at the highest. Hopefully they'll go down a little bit more, but we'll see. That's my projection for the rest of the year. They'll kind of stabilize or maybe trickle down ever so slightly. But when it comes to purchasing or refinancing, the lower the rates, if you get them too low, you're going to have a bunch of first-time home buyers come back in the market. Prices are going through the roof again. The Federal Reserve, the government doesn't want that. But at the same time, I think that where rates are, hopefully a little bit lower, is a perfect purchase and refinance market. A lot of clients, even if they lower their rate a half percentage point, they might be able to save $150 a month, $200 a month. So politics aside, based on the facts of the uncertainty, the fact that Trump wants lower rates, inflation's under control, the data that came out with the jobs and employment, I think we're going to hold tight, hopefully go a little bit lower. That helps my job and my clients for refinances, and also may help stimulate the purchase market even a little bit more. So we'll see how it all plays out, and I'll try to do an update later on if I feel that things change. But thank you, Chad the Mortgage Man.